Good afternoon and welcome to everybody here and on Zoom. And welcome to the Peking University School of Transnational Law, 北京大学国际法学院. And for those of you who don't know, our school is also known as STL for short, School of Transnational Law. Welcome to everybody here and on Zoom who are joining. We are very privileged today to have as our guest speakers in our public lecture series, Mr. Jay Lee and Ms. Choo Lye Tan. Mr. Jay Lee is a partner in K&L Gates' Hong Kong office and a member of the corporate practice area. And his practice area covers debt capital markets, securities, banking and finance, bond and debt restructurings, and green and ESG bonds and financing. He also practices in and has an interest in fintech, tokenized debt securities, and other crypto transactions and regulations, and regularly speaks and also writes about legal developments in these areas. We're also privileged to have also with us Ms. Choo Lye Tan, who is also a partner in K&L Gates' Hong Kong office. She focuses her practice on corporate and financial law and has dealt with ESG, CSR, and green issues on numerous fronts, acting for companies, investment funds, their directors, employees, suppliers, and other stakeholders. Mr. Lee and Ms. Tan will speak to us today on the topic of ESG, which stands for Environmental, Social, and Governance, and green/ESG financing in Asia. Mr. Lee and Ms. Tan will speak for about 40 to 45 minutes, after which we will open the floor for questions. I would like to now give the floor to Mr. Lee and Ms. Tan. Please join me in welcoming them. Thank you.
Hi, thank you everyone. My name is Jay Lee, as introduced by Norman P, professor. I'm a Korean, so nice meeting you all. But I'm from Seoul, Korea. I hope you watch a lot of Korean dramas. If you don't, please. There are a lot of interesting dramas about many things in Korea. I'm not going to talk about Korean dramas today, but a more legal topic, which is about ESG and green financing in Asia. It's good to know that we have a good turnout, and then ESG is a very interesting area, and it's a very promising area that you should try to learn about and should try to consider whether you want to do practice as a lawyer, as a professor, or some other profession, even in the future. Because some of my friends in the funds industry told me that it's one of the two key areas that he expects to see a lot of growth in the coming years and also decades as well. And also, as a good citizen of the globe, actually we need to care about ESG, but actually we don't. So it's something that we should all try to learn about ESG in other areas as well. Today, we don't have a lot of time, so we'll try to cover, as you can see on the slides, we'll do some overview of ESG and CSR. CSR means corporate social responsibility, and I will cover some green bonds, only basic ones, and also I'll give you some case studies so that you don't feel bored about these topics. And then I will go into a little bit details about how you do documentation as a lawyer on the green bonds deals. And then finally, we'll cover some other ESG and sustainable financing areas as well. Because over the years, it studied the green bonds, but also, and then it evolved into green loans, and then now it evolved into sustainable bonds and other things as well. So ESG itself evolving, but also financings involving ESG are evolving too. So we'll try to discover all those topics in the coming hour. Now I'll pass over to my colleague, Choo Lye, to talk about some regulations on ESG as an overview.
So obviously the key words here are sustainable financing. And the question always arises, where does that sustainable part come from? And The reason why we've mentioned CSR and ESG here is there's usually a lot of confusion about it. Obviously, CSR was the precursor to ESG. The term was actually first used around about 2005. And what we've put down here are the 3 key things to just bear in mind when you deal with corporate social responsibility, which you will see when we actually get to the next slide, that it actually overlaps with ESG. So obviously you have governance, you have sustainability, the social aspects, and then you have ethics, which is always a difficult question because ethics brings a qualitative element into things. You know, what do you mean by fair trade? What do you mean by fair dealings or fair treatment? So this concept of fair requires a qualitative assessment of that concept and what your agreement is on what fair means. So if you move into ESG, you will see, obviously, the E that everybody is very familiar with is the environmental part. You know, tree hugging, greens, being sustainable in your resources, trying to maintain the earth, and even improve upon it rather than taking away from it. But social, the S and the G parts of ESG, which is the social and governance side, is not as widely known or as widely publicized in that sense because it's much more difficult to quantify. I think with environment, you're pretty clear, you know, what causes damage to the environment, what's sustainable. But again, when you come to social, you know, question of human rights, slavery, health and safety, diversity, privacy and data protection. If you look at the history of ESG, you will see, and CSR, you will see it's actually a Western concept that has now been trending worldwide and has come over to Asia. And the problem with that is obviously because it started in the West, it was developed for a Western culture. So taking, for example, social, human rights and slavery, what's the concept of slavery? Using children to help you in your restaurant, to help you wait tables in a restaurant. Is that slavery? Is that an issue? Diversity. Now, diversity is something a lot of us in Asia sort of look at it and go, well, what's the issue here? Because we've never distinguished between races to the extent that we've never had the concept of slavery generally to the extent that you've had it in the West. And then privacy and data protection, obviously, that would be more global than the other 2 issues that I just mentioned. And governance, of course, this question of remuneration, diversity, again, internal controls, board structure, ownership. So the other thing also is that I think with many of the developing Asian countries, you will find out they have a history of cronyism, what is called cronyism, or preferences, family preferences, family treatments that are not common in the West. So again, this is a question of culture versus the international standard of, you know, what is fair in terms of remuneration and diversity, ethics and culture, and then again, bribery and corruption, as I mentioned. You have a lot of that in the developing countries in Asia. So you'd say, possibly, I've had lots of questions about how certain things could be done in Malaysia, for example, that would not be acceptable to the West or in the US, but it's part of the local culture and it's been common there for so long. So how do you change that is the big issue. And as we mentioned, the key drivers behind ESG, regulatory, commercial, moral, ethical, reputational, senior manager focus. Now, obviously, when you want to have an ESG culture, you need to have direction from the top. And that top needs to get some sense of what the current standards are, what the regulations are, what commercial issues are that they need to consider in setting up an ESG culture. So the next few pages here, we're talking about the initiatives that have been introduced worldwide on this. And obviously on a global basis, the EU, the European countries have probably got the most developed guidelines for this, followed by the US, and then obviously Asia tends to follow the West, as I mentioned. But it's obviously becoming a key issue because many of the regulators are setting up guidelines. Again, I'm going to say in Asia, there's no mandatory requirement that you have CSR or ESG policy. There are disclosure requirements if you're a listed company or if you're regulated by an Asian regulator. But these are disclosure requirements. There's no law that says you must do so unless you're actually regulated by those entities. But on your own, if you're a private entity, you can try to achieve those standards. You can follow the guidelines, but you don't commit any breach of law if you don't follow them. So again, as to give you a background of CSR versus ESG, I think you need to look at corporate social responsibility as more of internal culture in the company. It's a standard that, or a standard that you want to set for yourself, rules that you feel you should meet to be a good citizen. But ESG tends to be more the impact on the society and the environment, what you need to comply with to actually meet what you deem as international standards, which you'll find out as I get further on into this is also under question as well. But I like to think of it as more, if you're a person, your parents want you to be a good person. They tell you what the standards are. You think to yourself, what do I need to do to actually be a good person in this society? Do I need to contribute to society? How do I contribute in a way that is ethical by my standards? Right? So we will also find out that people have different moral standards, people have different ethics. But ESG is, let's just say you're applying for a scholarship, all right? So you set standards for yourself to be a good person, to be a good student. What do you need to do to meet that standard? I need to study X amount of hours. I want to get into this university. What does this university require from me? So that's your own CSR. ESG is what standards the university will apply to see whether or not you're an acceptable student. They will look at your grades. They will see, for example, what you contribute to society in terms of your extracurricular activities. So it's a standard used by someone to assess you, whereas CSR would be your own assessment of yourself, what you need to do to meet those targets. And you will find actually ESG, because it's actually used by other people to assess you, they will usually base it on data, a lot of data that's gathered from numerous sources. And why it's relevant in this day is because ESG is trending as the major factor in, I would say the generation now calls it an empowerment factor. You know, it's not something they're entitled to, but it's something that should be followed. They're using their power to influence society as a whole. So investors look at it, regulators look at it, peers, that means your fellow companies. So obviously investors, from their point of view, they want to be good citizens. They want to invest in something that's green, that's sustainable, that helps the economy. And from their perspective, if they are pension funds, government funds, run by governments especially, they will care what they invest in, and they will, to the extent possible, as stakeholders in a company or an investee, actually try to influence the decisions. Regulators, of course, realize that they need to put guidelines in place and laws to the extent possible, although not yet, to encourage the economy, to encourage society to be better persons. Because again, if you don't put in your rules, if you don't put in guidelines, people won't know what to do. It's well and good to say, you know, be green, be good. But then the question becomes, what do I need to do to be green or to be good? So regulators are now putting in all these guidelines as well. The SFC has got guidelines on this, as well as the MAS. And that obviously is overall encouragement to companies, to persons who want to seek financing, that this is what they need to be to achieve better returns. And peers as well. So in the same way that you have peer pressure, let's just say a lot of your friends, you and your friends are studying for a law degree. if they're all doing really well, you feel a certain pressure on yourself to meet that standard as well. So the thing is, when everybody else around you is doing ESG, is being conscious about the environment, society, about being ethical, fair dealing, fair treatment, you feel a sense to actually join in with them as well. So there's the hope that because you have your friends are meeting the standard and you're meeting that standard as well, that therefore you're as good as them. Then you have NGOs and public scrutiny, which is activism. I'm not necessarily sure I agree with activism as a means of causing people to care about something, because that can be taken to these extremes in the sense of naming and shaming and penalizing somebody because they're not doing what you think they should do. And that again goes back to the qualitative standard. Because for me, I think it makes more sense to actually engage them in a discussion as to why they cannot comply. And there are a whole host of factors. So the thing about ESG to realize is that it's a moving target, and there are many factors that contribute to what is deemed acceptable. And just because, I'll give you some examples later on, but you will see why having a tick the box or a standard list of things that you need to do to meet that requirement is never a good idea. So there's argument that you get increased financial returns because obviously now that you're ESG friendly, if you're a listed company, more shareholders will invest in you. The Generation Y, is that the current generation, the investing, those in the 25 to 35-year age group, the investing public, they're actually concerned with what they invest in anymore. So it's not a question of just making money on stocks, listening to the current gossip on which are the latest startups, but actually investing in companies that the investors believe will be good to the earth, will be good to them, will contribute to society, and make a better future for us. And then, well, the last one, incentives and grants. Obviously, I think at the end of the day, we talk about ESG as a good thing, as an ethical thing, as something that makes you sleep better at night. But also when you have regulators, when you have countries, when you have pensions giving you incentives and grants to actually meet those requirements. If you meet certain requirements, for example, in Singapore, the Singapore government actually has grants for green construction, meaning if your buildings meet a certain requirement in terms of minimal air conditioning, solar power, you can actually get money from the government to deal with this. And then you also have investment funds, tax benefits, tax incentives, rebates, if your funds are invested in a certain percentage of green products or green investments. The other thing also is the fact that you have many financial regulators, many sovereign wealth funds who are actually investing in startups which they have set their standards for in terms of being green. And this encourages companies who are seeking financing to actually meet those requirements as well in order to be invested in by sovereign wealth funds. The classic one would be Temasek in Singapore, which actually has for itself set a net carbon target of by 2030. 2025, hopefully, for most of the investments at their investment funds levels, but 2030 by 2030 for the entire organization. So this is my favorite part, which is actually ESG concerns. If you notice, when I was speaking to you just now, I just said the concept of ethical standards, quality, is very hard to actually. I think if any of you do statistics or you deal with issues that, or you deal with data in general and you use data for any of your conclusions, you will know that data itself is subject to corruption in certain instances because of the various factors that are used in compiling that data. So the current trend now for ESG is ESG ratings by agencies. I probably wouldn't use the term agencies because they're not actually It's almost like a self-professed agency, as in, I tell you I'm a ratings person, and I will rate this company because I have various ESG methods to rate them. And obviously building up enough traction that at some point in time, after you've gotten 1,700, 1,800 type clients whom you've rated, then you can start calling yourself an expert on it. So there isn't any regulatory control over these ratings agencies at the moment, and the regulators realize it's a big problem. But the even bigger problem is coming up with legislation to or guidelines to cover this, because ratings are just so vast. They are difficult to quantify, as I mentioned earlier on. It's difficult because the basis on which they use it is different across the board. There are so many vested interests involved. The assumptions that you use to produce that data can be different for each party. Some of the bigger ratings agencies that we typically see would be Sustainalytics, Refinitiv, MSCI. But if you look at them, many of them are owned by index providers who then provide those indexes. They sell it to other clients. And so the question is, how reliable is that kind of data when it's actually provided by somebody who profits off people who buy that? The other thing also is, what is the methodology used to actually rate these people? A classic example would be Tesla. I assume you all know Tesla, the electronic. Yes, okay. Tesla was actually, so Standard & Poor has what they call an ESG index. And Tesla was on it until 2022 when it was booted off because they claimed that it had unfair practices. And ironically, this is, unfair practices in terms of labor discrimination and labor dealings in its factory in California. So yeah, this is a first world issue there. But at the same time, Exxon, I'm sure you're all familiar with Exxon. Exxon is actually on that index still. So there's a question of, wait, why is Tesla out and Exxon is in? The argument was that Exxon contributes to the environment through carbon credits. It is committed to a sustainable future. And there's also some argument that stage 3 emissions, which is what you're actually talking about, the pollution to the environment, and you measure, how much is actually emitted by various, in Tesla's case, obviously it would do a lot better because its emissions would be a lot lower. But it's actually not a measure that was used to measure the two companies and rate the companies against each other, which is why Exxon actually ended up in a better position than Tesla, because they didn't measure the low rate of emissions by each company, which is rather odd, but at the same time, that's what Standard & Poor stands by, and nobody can question it, because at the end of the day, it's an ESG index that Standard & Poor came up with, and they stand by it, they sell it, and people actually use it to rate whether or not a company is worth investing in. So by definition, if you actually bought that rating and you decided to invest on the basis of companies that are, category A in green, you could actually, Exxon would be a kosher investment versus Tesla. So regulators try to deal with this through ESG compliance reporting, but as I mentioned, really, unless you're listed and you're subjected to those listing rules, or you're authorized by a regulator, there's really no need for you to do any compliance reporting at all. And some companies also try to deal with it through due diligence, but the question again is, what do you use to actually measure quality or measure ESG compliance? Measure ESG goodness, as it were. And then at the same time, we have green hushing, which is the other thing. When you tell people, you need to tell us, whether or not you're ESG compliant. And the response is, we have nothing to say about ESG. That technically is answering the question. And that's actually what a lot of funds actually do now, because again, if you can't tell me what the standard is, if arguably Exxon fits the kosher investment benchmark, but Tesla doesn't. I don't want to say that I am green and then have somebody come after me for lying or misrepresentation in my prospectus, fraudulent claims. So I'd rather just say nothing. And the problem is when you say nothing, then it becomes this whole area of, are they compliant or are they not compliant? So I'd rather say nothing than say something and then be deemed non-compliant as a result. Then you have carbon trading, which arises from the use of carbon credits. The abuse that arises from it actually arises from manipulation of data. And the question is this: most of the carbon credits, or most of the countries that have carbon credits that they can sell to countries that need to buy those carbon credits, they're actually primarily from South America, Africa, some Asia, but not so much now because we're developing so quickly. And so the question is this: what did you do to actually develop those carbon credits? Was it through use of local labor? Was there any slave trade involved? Any fair human trading, human rights abuses? And that becomes another question altogether. So how can you be buying carbon credits from countries where the local indigenous communities were removed from their premises or moved out, where they actually practice, for example, slash and burn cultivation, which then damages the environment? So again, that's why I say ESG, there are a lot of moving parts to it. And finally, as I said, the issue of setting appropriate standards. What standards do you need to meet to actually be deemed ESG compliant when you have all these issues with ratings, with compliance reporting, with due diligence, with dependence on data that may not necessarily be reliable. With that said, so now you have an idea of what ESG involves. I will leave my colleague to take you over to green bonds.
Thank you, Choo Lye. Thank you. So now I will talk about some of the green bonds, but before I move on, to make sure that you all aligned with me, can I give a quick quiz? I love to give my quiz to my daughter, which is 8 years old. So try to be more interactive and lively. How many people know what it means by bonds? If you know, can you raise your hands? Yeah, I can see agree, gentlemen, ladies may know, but what about others? Oh, only a couple of them. Then can I ask you whether you can distinguish between loan and bonds? Oh, tough question. Oh. Yeah, very good. Very good. Sure. Sure. Very good enough. Professor Ho, how much credit are you willing to give to her? Good to hear. What about, is there anyone who can supplement what she said? All right, Annie. So bonds are simply I owe you, right? You lend me, so I say I owe you, right? That's evidence of I owe you. I borrowed money from you. However, bonds should be considered securities, 证券, securities, and the loans should not be. So that's a big legal difference. But securities means actually when you issue bonds, then those bonds can be transferable to anyone, and they can be listed on, for example, Shenzhen Exchange or Shanghai Exchange as well. So those are bonds, but loans are typically not supposed to be transferable or liquid, not as liquid as bonds. But also, when you get the loans, you can transfer loans to somebody else too. But typically, much less liquidity and much less transferability. So those are the big differences. But so bonds are something that the companies use to get the money from the public. That's the key difference, I guess. So those are the bonds. And now, what are green bonds? Anyone can answer what the green bonds are? Now we know what bonds are. So what are green bonds? Anyone who can answer? No? Then, so, yeah, please. Yeah, 95% correct. So very good. Thank you. Yep. So green bonds doesn't mean bonds which have colors of green, right? But green bonds are bonds which are supposed to be used for helping green projects. So we go into details about how green bonds work, but before we go into that, I'll give some history of how green bonds have evolved. So ESG has been part of DCM. DCM means the debt capital markets world for many years. In Asia, about 12 years, I think, as Choo Lye said. It started from EU and then US, and then Asia tried to copy it. So it started late in Asia, so about 12 years. One of my first green bonds was maybe 8 years ago in Hong Kong. So that's the history. So it has been part of debt capital markets. And traditional example is green bonds. So ESG, G stands for green governance, but E stands for environmental, which covers green and also green bonds as well. So, but now, as ESG has been evolving, therefore bonds are evolving to capture all those evolution of ESG as well. So now we have social bonds, which try to help improving on social issues. For example, Choo Lye said slavery issues and others as well. And I did one social bonds in, I think, Thailand to help on their social issues. So now they have a social bonds as well. And when you speak about social bonds, green, and then also green bonds, and also we have another one called the sustainability linked bonds. Why can you call them as a social bonds? For example, green bonds. There's sort of it's a name, right? So you can issue something and then you can name as a green bonds, correct? However, to make green bonds more, how can I say, reliable, trustworthy by investors, some institutions have come up with some principles. So those are called, for example, green bond principles. And I got some principles like this. So it's a sort of booklet where it's made by ICMA. ICMA is International Capital Markets Association. International Capital Markets Association. It's a big organization of capital markets participants who do capital markets works. For example, we are one of the ICMA members as well. So ICMA published these principles, and if you look at the inside, there are certain principles that you need to follow, which I'll cover later. So that's one thing. And then, so social bonds, then you gotta have a social bonds principles too, right? So they have come up with the social bonds principles too. I got something, I don't know where it is. Sorry, I'll try to find it and, I found it. So like this, social bonds principles, announced by same organization of ICMA. And all those principles, establish some framework that all the issuers have to follow to comply with the ESG. For example, when you do green bonds, for example, you got to do green bonds framework. I will show you some samples later, setting out how the issuers will comply with the green principles. And also, typically, you need to get an opinion from somebody else, which is not the issuer, which is called a second-party opinion provider. Choo Lye talked about sustainalytics, quite difficult to pronounce, and visual areas. And also these days, Fitch has come with its own second-party opinion provider servicing firm as well. So there are separate party who is different from issuer, who is giving you second-party opinion saying that this is in compliance with, for example, green bonds principles. And once you issue bonds, then you got to do ongoing reporting, which will be done by the issuer. Sometimes they do it on their website. So those are the basic parameters that we need to follow. But for the green bonds, its focus is on use of proceeds, as we discussed. Once you get the money from the issuing bonds, they are supposed to use the money to work on the green projects. So that's the key focus, which is on the use of proceeds, how you use money. However, when we did a green bonds, there was a big problem, which we call lack of teeth. Lack of teeth means you don't want to eat beef, but you don't have a teeth, so you cannot eat beef, although you can see the beef. Why? It's only focusing on how they can use money for the green projects, but Professor Ho is the investor of green bonds, issued by, let's say, company A based in Shenzhen. Once he buys the bonds, he doesn't know whether the issue is using the money really for green projects, right? He cannot go to the company every day and then watch whether they're using the money only for the green projects. You cannot. So there's no way to track whether the money is really used for the purpose they set in the document that they will use. So that's why it is called the lack of teeth. And that's why we had an issue of greenwashing and all those greenwashing, all those things as well. However, the only way that you can try to do, once you find that they are not using money for the original purpose, then there was a misrepresentation by the company, and then maybe somebody can call the newspaper and then make a big news, then reputation impact. That's all. So about 6 or 5 years ago, ICMA got all these comments saying that green bonds had some big problems, which is a lack of teeth. So then we tried to come up with some new evolution. So they have come up with a sustainability-linked bond principles, which is this one. So similar booklet where they set out what they need to do. Was June 2020, and then its a potential solution is the issuer doesn't have to use money for green projects. However, the money can be used for general purposes, but when you do follow certain parameters, then we'll give you incentives. For example, I will explain this thing in more detail later. There is a key performance indicator, which is KPI. Then once you comply with it, then your interest rate then you need to pay can go down by 0.25 point. So then company has an incentive to follow what they said, right? And then, so therefore there's an incentive given to the company. And then from the investor point of view, they can they have a better assurance that the company will use for something good for the green projects. I will explain this thing later. So that's the sustainability-linked bond principles and sustainability-linked bonds. And now, as I said earlier, the market have been evolving. And now, then do we have only green bonds and social bonds? We have other things as well. About 10 or 9 years ago, we had only one green bonds. then it's called the standalone bonds. Standalone bonds means the company issue only one bonds and sold to the investors. We have another bonds product called MTN. It's a medium-term note program. The simply speaking, what it means is you make a program, and then whenever you want to issue bonds, you take out one document from the program and you issue the bonds. Then why do you have an MTN? Then from the issuer's point of view, much quicker. You don't have to make 100-page offering circular every single time that you want to issue bonds. You make an MTN program documentation. Whenever you want to issue bonds, then you make it's called a pricing supplement out of the program, and then you can issue it. Much quicker, much cheaper. So that's the program. Even in these MTN programs, now you have green bonds concept built in. So you can just check this is green bonds, and then green projects are blah, blah, blah. Then you can issue the bonds. So it's a lot of efficiency given to the issuers as well, because they can use MTN programs. And now that's not the end of it. Now we have seen green convertible bonds. Convertible bonds means it can be changed to something, right? So convertible bonds means it's a bonds, but can be changed to equity shares of listed companies later. That's the convertible bonds. If we want to do private equity, venture capital, other things, you need to understand how convertible bonds work, because they are used in many of those funds investments. And others, there are others too. For example, ESG linked securitization as well. I will explain a little bit later. So the market now have evolved to cover some other new products as well. And then the key issues that you can think of all the time when you think of ESG bonds or ESG products is, from investor point of view, I can buy bonds issued by Alibaba, which may not have anything to do with the ESG, but they can pay maybe me better. We don't know. But you have one green bonds issued by, let's say, Shenzhen government. Which one do you want to buy? What are your main considerations that when you want to buy bonds? It's a coupon. Coupon means interest rate, right? You give $100, can I get $10 back? Or can I get $5 back? Which one you want to buy? $10, right? So investor point of view, they always care about how much return they can get. But if we want to sell more green bonds, as an example, then we need to find ways to give investors more interest rates, right? Then they are naturally buy. Otherwise, I am a good citizen as an investor, so maybe I get less interest, but I am willing to buy green bonds. Those people too. But if they want to have more investors who want to buy green bonds compared to typical old bonds, the interest rate can be workable better for the investors too. Still, market is working on them, but that's always big concern. But sometimes in Hong Kong, in Korea, sometimes you can get better return from the investor point of view when they buy green bonds too, but not always. But this is something that they always care about. Then issuer's point of view, it's the other way, right? From issuer's point of view, when they pay more interest, it's more expensive to them. So from their angle, they need to find a way to make green bonds where they can pay less interest. It's a sort of a conflict between two big parties. So then how green bonds can give us some mechanism where issuers can get less interest payment to the investors. So there's always this conflict between the two big parties, but the market is finding ways to get there, and sometimes issuers can get actually a lower interest rates as well. And now we'll give you some case study. It's a Korean company. It's called Hanwha Solutions. We worked on. It was a renminbi denominated. I'll just go over quickly. This one followed green bonds principles. And when you want to issue green bonds, which are in compliance with the green bonds principles, then as you can see, there are 4 core components that you need to follow. One is user proceeds, and then the other one is process for project evaluation and selection, and management of proceeds and reporting. Those are all conceptual words, right? So how can they do it? For example, when you look at some documents, we call offering circular. So that's the offering circular. So as I said, bonds are securities. So therefore, every country, maybe I don't know about African countries, but every key economic countries have securities laws. US has it, Hong Kong has it, China has it. So once you are on the parameters of securities laws, then there are things that you need to follow. And then one of them, although you don't do retail investor-based issuance, there are certain qualifications that you got to follow. One of them is to make sort of a, we call it disclosure document, where you need to disclose about the company, about the bonds, for example. So this is we call it offering circular. Offering circular, if you look at the offering circular, all those contents that you can see on the slides are set out there. If we look at the pages, for example, user proceeds, it's also renewable energy. So the company said that they will use the money to facilitate renewable energy generation in countries where Hanwha operates and advance UN Sustainable Development Goals, which Choo Lye covered earlier. So those user processes should be set out in the disclosure document. Then they need to comply with it. And then the second one is process for project evaluation and selection. So then they need to select green projects, right? And how they do it, they need to set out in the offering circular too. And in this particular case, they set up Green Financing Working Group. And it is composed of members of their accounting, planning, legal, environment and safe teams and other teams as well. And the main objective is this team is to oversee and select eligible projects under the framework. And third one is management of proceeds. So then you got the money and then how you can use it. So in this particular case, they are supposed to track and manage proceeds of each issuance on the green financing framework. And then what is the green financing framework? I got one sample as well. So whenever one issuer wants to issue green bonds or even green loans, they need to make some green financing framework, or sometimes called the green bonds framework as well. Sorry, I cannot find it. Too many documents, but just 1 minute. So this is a green bonds framework. So they make this kind of framework where they set out to comply with the green bonds principles. For example, what they do. And there are many details in it, including management process as well. And in this case, it's different, but in the case of Hanwha, they use the green financing framework. And therefore, they can use it for green bonds, but also they can use it for green loans as well. So that's why they make a green financing framework instead of making green bonds framework. So whenever green bonds come out, you can see that they need to have some green bonds framework or green financing framework that the company has made, but also you should be able to find it in the offering circular as well. And net proceeds will be tracked using separate ledgers according to Hanwha's internal procedures. And then they plan to reach a full allocation of procedure within 24 months of issuance. And then finally, that's a fourth component, which is reporting. So for the reporting, Hanwha intends to report on the allocation and impact of proceeds on its website. That's typically they do. Allocation reporting should include the total amount of proceeds allocated to eligible projects, balance of unallocated means unused proceeds, and shares of financing and refinancing as well. Some other things they can set out in their reporting, which is on their website. And then there should be external review. We discussed certain Sustainalytics, and then they have provided a second-party opinion on Hanwha's green financing framework. And then, but in this particular case, they made a note to that they are aware that certain eligible projects should also lead to negative environmental and social outcomes. So these external reviews, they can include whatever observations they have on green financing framework made by the issuer, but also how they are trying to follow the green financing framework, and also whether it's in compliance with the green bonds principles. All right, the green bonds documentation. Quickly going through, this is quite technical, but as I said, bonds are securities, and therefore they are subject to securities laws of countries. And one of the requirements that we have developed as a market participant to make bonds to comply with the securities laws is make some documents, and one of them is offering circular. As I said, this is offering circular, and if we look at this offering circular, there is a section called the risk factors, and where the company can set out all the risks that they may think of on the company, on the business, and also on the bonds as well. So for the green bonds, typically risk factors, if you look at them, you may say there is no market consensus on what constitutes green or sustainable, which is still true. There are certain categories, but there's no legal definition, I think. And the green aspects may not meet the criteria expectation of the investor. And also green project may not be capable of being implemented or completed. Makes sense, right? I mean, they say they will use money for green project, but it's not 100% sure that those green projects may be sort of completed within their time. And then the critical part, we talk about lack of teeth. The issues of failure to comply with such green principles may not trigger event of default. So even if they breach, you cannot go and then, hey, you breached this, so we want to call it event of default, and please pay back my bonds. So you cannot do that. So all those risk factors should be set out in the offering circular. And also, green bonds, the key focus is on the use of proceeds. So therefore, the offering circular should have a section called the use of proceeds, where they need to set out how they can use money. For example, in this particular case, there's a net proceeds to be used for the purpose on the relevant green bonds framework. In this case, it should be green financing framework that Hanwha used. And then another key point that you want to remember is when issuers issue securities, bonds, they always have banks who are supporting the companies issue bonds as it's called the managers, or sometimes underwriters. And then the underwriters don't want to take any responsibility. So typically they say they will not verify or monitor the proposed use of green bonds. And then, however, as we discussed, the terms and conditions of bonds, which are the binding agreement between the investors and the issuers, the under current market practice compliance with the green framework are not tied with the terms and conditions of the bonds, which was the problem. As I discussed, it may not trigger any event of default. So that's the issue that we had on the green bonds. And then there is a document called the subscription agreement, where the banks come in to say they will buy the bonds from the issuer to you, and then we sell those bonds to investors like you and me. Has to be professional investors, but anyway. And then in the document, always there's a section called the use of proceeds as well. And then typically says that the net proceeds will be used in the manner specified in the offering circular. And in the offering circular, it will say that it will be used for the green projects. And the conditions precedent, which is they need to comply with this one to get the money from the banks as underwriters. That's called the conditions precedent. We call it CPs in simple speaking. And there's a CP called the Green Bond Framework, and second party opinion should be part of CPs as well. And trust deed is a little bit more complicated, and then it's a trust deed between the issuers and the trustee. And then why do you need the trustee? When you issue securities and bonds, there are too many investors. For example, in the US, if they issue treasury bills, then maybe there may be many investors. Then the US government cannot have an agreement with every single investor. So typically, we have a trustee who is working for the investors and sign the document on behalf of the investors, theoretically. So we have a trust deed between the trustee and the issuers. And then even on the trustee, they don't want to take responsibility on something goes wrong on the green bonds. So they will say the trustee will not be under any obligation to monitor or supervise the issuer's compliance with the green bonds framework, which makes sense from trustee's point of view. Additional requirements. Maybe you can try to build in separate requirement with the issuer that they should comply with all the green project requirements. It's just something that maybe after you come out of the law school and you can invent. I haven't done it as well. And now that's the key part of green bonds. But as I said, the market is evolving because ESG itself is evolving and it's getting more important issue every day. And other than green bonds, what do we have in the financial markets? As a key factor, there's always different angles. When you want to do sustainable finance, which includes green bonds, typically the driver comes from policy and framework, as Choo Lye discussed. There are pressure from the supranational entities like UN and others, and also the government as well. And then the regulators follow through and then try to come up with some policy and frameworks that companies and listed companies have to follow. And then also there's a strategic opportunities for the banks. For example, they want to make more new ESG financing products to be sold to investors and also to be borrowed and to be offered by the issuers as well. For example, green bonds, green loans, green commercial paper, green structured loans, and some other things as well. And also investor landscape, as we discussed, and the financial services landscape, for example, underwrite activity, and also rating agencies, Choo Lye discussed, and they want to do more business on ESG ratings as well. So all those angles come together to support sustainable finance. And taxonomy is something that she discussed, and then now even Hong Kong is trying to come up with its own taxonomy to have some classification as to what can be considered as a green, for example, green projects. And now other ESG bonds, it's more interesting.
So sorry, Jay,
Yeah.
maybe you could just wrap up because I want to make sure we have time for questions. Yeah. Maybe
Sure.
1 or 2
Okay.
minutes. Yeah.
Social bonds. So it's a social bonds which can be used for improving social issues. And then as you look at it at the bottom of the slide, that's how it looks like a social bonds principles. I showed a hard copy as well. And the ASEAN itself has come out with its own social bonds principles that you can try to use when you want to issue social bonds in ASEAN countries. There's a typo in ASEAN, but it's ASEAN. Sustainably linked bonds, it's as I discussed, it's not tied with using money only for green projects. Two concepts. There is a KPI, it's a key performance indicator, and then also SPT, it's a specific performance target. Sustainability performance target. And how does two work together to make sustainability linked bonds? For example, in the bonds document, you can say KPI number 1 is a new production capability of hydro wind power. That's a key performance indicator. And SPT number 1 should be 2,000 megawatts by December 2025 on this KPI number 1. And if the above SPT is not met by December 2025, for example, then 25 basis point, which is 0.25% of the interest step up. So if we don't comply it, then the issuer's interest rate goes up. That's how it works on the sustainability linked bonds. But as I said, the money that you get as an issuer from the issuance of bonds don't have to be used only for green projects. And then social bonds, we discussed it. And other ESG bonds, I'm sorry, we are going backwards. And then we have sustainability loans as well. So similar concept to sustainability bonds. So for example, green loan principles, green loans principles issued by Loan Market Association and also the Asia Pacific Loan Market Association as well. They follow similar concept to green bonds principles. So I will not go over details. And as I said, for similar to green bonds, there are 4 core components. And this is how green loan principles works. And then one of the key points on if you look at the green loan principles, they list out typical green projects as appendix 1 to green loan principles. So if you look at the left side of the slide, you have a list of the green projects that you can try to use for your proceeds. And then also loans also has a sustainability linked loans as well, and they have principles as well. And then we have issued some the sustainability linked loans. And then also securitization. Securitization is you put out underlying assets to make a pool, and then based on the pool, you issue new bonds. That's the securitization. But now also, we have seen sustainable securitization to use the same technique to help on the sustainability as well. And now I can hand over to Choo Lye to wrap it up quickly.
I think very quickly, if you just look at the title, these are additional points of financing a company's products. So you have investment products. I'm sure you've all heard of the Wealth Connect. You've got various ETF connects between Hong Kong and Shenzhen/Shanghai. And the idea essentially is to create new products that would appeal to an audience that would be interested in investing. So these are what we mean by hybrid products, as in you use various combinations to access the market, but which are green and sustainable. Same with ESG funds. We've gone through that previously, sustainable funds. And then private equity is actually from the investor standpoint, because as you know, most of the biggest private equity investors are sovereign wealth funds, pension funds. And so from their perspective, many of them have ethics committees, which require them to invest in ethical industries, in ESG type industries, in green funds. So those will be relevant to people who are looking for financing. I think if you just look at what Jay has gone through in terms of a practical perspective, there's ultimately driving this for corporates is making a profit. There's no point issuing a green bond if you can't find investors. And the reason why you can't find investors is because they have ESG standards that they need to meet through their ethics committees. If you don't meet those standards, then they cannot invest in you. So the whole point of the green bond, it's a wonderful concept, but if you can't find investors to buy into it, that's not going to work. From a green loan perspective, if you want to take money from a bank, but that bank is subject to ethical standards as well, they won't loan money to you, and you can't get the benefits of that. From a corporate perspective, if you want to make profits and you want to reduce your costs, you could apply for incentives or grants from governments, assuming you met their standards. But I think, the thing ultimately is you've got to use profit as a means to drive corporates and to incentivize them in ways that you can't otherwise do so. There's actually studies that show that returns from ESG funds, returns from environmental investments, or companies that have been deemed to be ESG friendly are actually higher than the average returns from non-ESG companies. I think what we want to just emphasize from all of this is that essentially it's an ongoing process, it's a changing process. Even the data that is published right now can be subject to change. And it's always going to be an issue, but awareness is what brings it in, and awareness through actually engaging the public, getting their opinions, not through penalizing, not through just pure activism alone, or you're a bad person because you didn't meet these standards, after having explained to you how standards can vary. So it's overall, I think we're all working together to make it profitable for everybody, but in an ethical way. And again, ethical has got to be to the majority.
Okay, thank you very much.